Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with the one and only and legendary Mr. Greg Dickerson. How you doing, sir?
Doing great, Michael. Good to see you.
Absolutely. So, as you know, undoubtedly, we get a big number next tomorrow. CPI expectations for headline are 7.3, month on month 0.3 for both headline and core. But I want to actually talk about the bigger picture of inflation. Jeremy Siegel, who is somebody you've probably heard, a Wharton professor. He's often thrown on CNBC. He is saying that inflation is over. We are already seeing disinflation and we'll soon see deflation. He thinks the Fed will raise 50 basis points Wednesday and pause all of next year and ultimately cut 200 basis points because of a recession. What I wanted to ask you is, do you see inflation that way, or do you see part of inflation being easy and another part of it being structural or sticky? Because I think somebody's thoughts on inflation will drive investment decisions. And I was just curious what you thought about inflation.
Yeah, so I think some parts of it are going to be stickier than anticipated, higher for longer. Other parts are already coming down. Commodities are already backing up, coming down. Those, by the way, are recessionary indicators. Commodities dropping like they have, but oil's down, lumber's down, copper's down, those types of things. But what we're still seeing very stubbornly high is food for the most part. Energy, it's come down, but it's still high. It hasn't come back like some of the other commodities. I mean, gas is still, and on average over $3, which is not cheap. Generally, it should just be over two or at two. So that's still pretty high. Energy costs this winter are hitting a lot of people. Things like that. Health insurance premiums came down. That's what dropped inflation last month. That was the reason that was lower than expected, was because health insurance
One time
premiums.
adjustment. Yep.
Yeah, food's still higher, labor's still higher, cost to produce goods is still higher. The labor market is still way out of balance. Real estate as a whole, when you look at the median house price, I mean, it's still up, and I don't think that's come back yet. And
Not
rents,
nationally.
yeah, and rents, on average are still up, although some markets, it's coming back. So there's going to be elements that are going to be stickier than they think, but I think we might potentially see a quick retreat back to about 4%, but I think that's where it's going to stay. I think they're going to have a hard time getting inflation below that 4% threshold if it can get back to there. And that, we could see that as soon as, Q1, Q2 next year.
Wow. Yeah, because it's funny that you say 4%, because that's actually the number for me. So this is how I break it down. My audience may know this, but in case it's the first time they're watching, I think there's an easy component of inflation, which is stuff, which you correctly said, lumber, commodities, all of that coming down. I think that takes us from what was the high water mark of 9.1 to 6. Then there's what I call the hard, and that's housing, rent, owner's equivalent rent. I think that and again, I think we get to 6% in Q1. I could see that. Then from 6 to 4, I think that's a lot slower. A lot of it's because the data is backward looking and all of that. I don't think we see 4 until late Q3, early Q4. And then there's the structural stuff that I actually think might be years, right? Wages, services, onshoring, bringing manufacturing back, de-globalization. I think there's a chance, Greg, that we have, 3.8, 4.1 inflation for a couple of years. Do you think that's possible?
Well, I think it might be permanent. So I think
permanent. That would be more than a couple of years. Permanent.
So, if wages have adjusted and they're going to stay there, then arguably prices can be a little higher. So it's just your next evolution in that target rate. I'm not so sure the Fed will ever get back to a 2%. They would have to completely destroy the economy to do that. Yeah. So I just don't think they will ever be able to get back to 2%. I think the new normal is going to be around 4% for inflation.
Wow.
And
that's game changing.
Well, I mean, how are you going to back wages up? You have to really destroy the labor market, which really affects the economy, which really, and this is a global thing.
Oh, it's global. So, this is global. Yes.
Yeah. And, the speed of which, inflation drops next year, I could see us getting, closer to 4 or 5, like you said, by the end of next year. How quickly it comes down, who knows? But I just don't think it's going to go much below than that, unless you get into a super stagflationary environment where, there's just absolutely no growth. People are getting laid off. Nobody's spending any money. Then it can come back. But the economy's still pretty strong. The labor market's still pretty strong, and
Yeah.
wages are not backing up anytime soon.
Yeah. I really, yeah.
And there's a lot
Wow.
of people that still have a lot of money. I know that people watching this might be struggling. Maybe they lost their job, whatever the case may be. A lot of people have lost a lot of wealth in the markets and crypto and things like that, real estate. But there's still a lot of people that have a lot of money and a lot of spending power out there
Yeah.
that kind of outweighs the other.
Yeah. When you think about 4%, I was willing to look at 4%, again, 3.8, 4.1, right? That little range until like 2025, right? That's kind of how my mind went. But yeah, talk about that being permanent. Because how I translate this is I try to figure out inflation, because for me, inflation becomes, what does the Fed do? Right? Because again, I'm in the real estate business. It's a debt business. Cost of capital is something I'm concerned with. So if we could, if inflation's running at 3.8, the funds rate's got to be north of 4, which means, maybe long-term mortgage rates are, I don't know, high fives, low sixes. So we may be going back to what I was paying in 2005, 6, 7 for debt. What do you think?
Well, I mean, historically, that's where it was, right?
Yeah.
Historically, interest rates were in the sevens, 5, 6, 7%. What we've seen in the last 2 years is just not
Abnormal.
normal. It's very
No.
distorted. And then even before that, since the bottom of '09, I mean, rates never really got above 5%. Anytime they got near 5, the market would crash. So the reason I'm saying this is because if you think about, why do we even have a 2% target to begin with? What is that all about?
Yeah.
That number gives the Fed room to reduce rates to stimulate the economy, increase rates to slow it down. So that's why they have a 2% target. If they target zero, zero inflation, which would be a deflationary outcome, would be zero. Disinflation is just inflation backing up. We're already getting
Right.
that in commodities. But deflation is, stagnant lower prices in the long term. So let's just say you got to a zero interest rate or a zero inflation rate. I mean, there's nothing the Fed can do to stimulate the economy at
Yeah.
that point, other than just throw money
Pump.
out there.
Yeah. Pump. Yeah.
Yeah, through stimulus and all these other things. But so that's why that 2% is a number. The question is that a realistic number given the current state of the economy and global economy moving forward? And
Yeah.
is it enough cushion for the Fed to be able to do anything? That's why I think somewhere around 4, it could be 3s to 4,
Yeah. Yeah.
is
Yeah.
probably where it's going to level off. And it just, again, they'd have to do so much damage
Yeah.
to get it down, below that level. Cause like you said, the Fed funds rate has to go up above it, and that would just destroy markets.
Yeah. I think it's wild that you've correctly pointed at this, because there's a lot of economic papers I've read over the last 30 days that are basically saying the Fed has to give up on 2%. Some are saying, hey, do they go to 2.5? Do they go to 3? I don't think I've read a paper yet talking much above 3, but I think there's a general understanding that this era, which is 3, 4, 5, 10 years in the making, is going to force the Fed to revisit their 2%. And that'll be game changing, right? And again, back to your point from the earlier video, a lot of that debt people had the last 2 years, that is now an asset. If you're in residential and you have 30-year fixed rate debt at 2.8, know that debt's an asset. There will be people that will pay more for your house to assume that debt. So the next 3 to 5 years are going to be amazing to watch.
Yeah, it's pretty interesting. And I mean, nobody knows what's going to happen or when. It just seems to me that inflation is going to stay higher for longer than we think, because the only way to get it down is you got to completely destroy demand, and that's not happening.
Yeah. Yeah. Pretty wild to think about. Greg, where can people find you?
Yeah, gregdickerson.com. That's where all my info is. Go check it out.
Awesome.